If you're carrying a credit card balance for more than 90 days, you've already triggered a trap that can tank your credit score and cost you thousands of dollars in interest, and most people don't even realize it.
Credit card balances have hit an all-time high just as rates are rising everywhere thanks to the Fed's rate hikes.
Credit card companies have a hidden rule that activates after 90 days, and once you're in it, getting out is way harder than you think. In this video, I'm breaking down exactly how this rule works, how banks use it to keep you in debt, and what you can do to escape it before it's too late. Here's the deal. Once you've carried a balance on your credit card for more than 90 days, most banks will lock you into an interest cycle that makes it nearly impossible to pay off your debt without getting hit again and again. Now, here's the crazy part. It's not illegal, but it's predatory by design. As you can see, after 90 days, you're no longer just a customer. You're a high interest revenue stream that comes in every single month. The banks know that if you haven't paid it off by now, your odds of becoming debt-free drop dramatically. And the credit bureaus start flagging you differently too. Now, if you're watching this and you're thinking to yourself, that sounds like me, then don't panic, okay? I put together a free credit guide that shows you exactly how to break this cycle. You can scan the QR code right here on your screen or click the link in the description below to learn more. Let me walk you through how this 90-day interest trap works, okay? And how it affects your credit score, your wallet, and your long-term financial freedom. Number one, the compounding interest snowball. Here's the thing. Once you hit 90 days with a balance, banks assume you're going to be a revolver, okay? This is someone who's more than likely not going to pay in full. That also means that your grace period disappears. Your interest compounds daily, and every purchase from this point forward is going to accrue interest instantly. This also includes even if you're paying the minimum monthly payment or just a little bit more. The balance grows because you're now paying interest on top of interest. Check this out. Number two, credit score suppression is going to begin. So after 90 days, the balance you carry starts to drag down your credit utilization, and that makes your credit score drop even if you're not missing any payments. For those who don't know, this is when you take your balance and divide it by your limit. But if your balance always gets close to the limit, you're gonna have a problem. Many FICO algorithms treat long-term revolving debt as a red flag, especially when it crosses 30% utilization for multiple months in a row. This also makes it harder to qualify for balance transfers, loans including mortgage loans, auto loans, and lower interest rate credit cards trying to keep you stuck, which overall is going to be keeping you stuck. Number three, internal bank behavior triggers. What most people don't realize is that banks have internal risk flags. Once your balance rolls over for 3 months, they're less likely to increase your limit, which means they're more likely to lower your limit. And in some cases, they can raise your APR without warning. Watch this.
And so what big credit card companies like Bread and Synchrony, and to a lesser degree Cap One, Citigroup, and Barclays said was like, a lot of our customers are subprime, a lot of them rack up these late fees, and as a result, we're gonna get killed by this. And so what they did was they decided to announce that they were going to jack up their interest rates, which you reported first, Gabrielle, to as high as 36%, and on average 10 percentage points higher than what general purpose cards would charge. And they also added things, sneaky little fees for things like receiving a paper statement in the mail suddenly costs $2.99. A lot of people didn't notice that. And so as a result, people were getting charged higher. Now at the same time, what happened in April of this year was that in the courts, the industry was successful at killing this CFPB late fee rule. In other words, it wasn't going to happen. And so the question that analysts put to the CEOs of Bread and Synchrony were, hey, what are you going to do? Are you going to hold on to these? And they answered in a very straightforward manner last month in conference calls for their Q1 earnings was, we're holding on to these enhanced fees and this higher interest rate. And at the same time, we acknowledge and celebrate the fact that the CFPB credit card late fee rule is dead.
Now, this slowly turns what started out as a manageable balance into a trap.
So many folks are drowning under the weight of credit card debt, as the number of accounts with delinquent balances has more than doubled since 2021. A report from the Philadelphia Federal Reserve also shows a record high number of people are only paying the minimum monthly payment on their credit card bills. It's peaked at nearly 11% of all accounts in the third quarter of 2024. You see it on that graph. And this comes as a new survey from Bankrate found that over half of Americans don't have enough savings to cover a $1,000 emergency expense. That's serious.
Now, here's how to break out of this trap, even if you've been stuck for months. Number one, pay early, not just on time. Let me give you an example. If your due date is the 15th, make a partial payment on the 10th and another on the 14th. This reduces average daily balance, which reduces the total interest that they can charge. Number two, freeze the credit card. Stop using the card until the balance is below 30% of your limit. Adding new charges keeps resetting the 90-day cycle in the bank's algorithm. Number three, request a rate reduction. A lot of people don't know about this, but you can do this. If your credit score hasn't dropped too low, call and request a lower APR. Here's something that you can say, and this works for many banks, okay? I've been a customer for X amount of years. I'm carrying a balance and I want to pay it off faster. Is there any way possible that you can help me with a lower interest rate? Now, many credit card issuers have special retention offers that you'll never see unless you ask, or of course, if they see that you're in some type of payment trouble of some sort. Number four, use a credit union for a balance transfer. Check this out. Some local credit unions offer 0% balance transfers for 6 to 12 months and without big fees. Navy Federal, for example, has no transfer fees. So look local. It doesn't have to be just the big name cards. It can be, your local credit union, and they may have a program that can work easily for you.
In Colorado, Keelan Thomas and her husband are on a mission to keep spending down and pay off the last of the $15,000 in credit card debt they ran up after getting married.
We want to be able to buy a house, and we don't have a house yet, and we are in our 30s, and that's hard, but it's because we made the choice to use the credit cards thinking that we'd be able to pay it off easily.
As inflation soars, new data shows many Americans are charging it. Credit card debt has jumped 13% in 1 year, the biggest increase in 20 years. And Americans opened 233 million new accounts, the most since 2008. While balances still remain below pre-pandemic levels, interest rates, now averaging 17.4%, could soon soar to record highs as the Fed continues hiking rates to fight inflation. If you're carrying heavy credit card debt, financial experts recommend cutting it down as fast as possible.
The 90-day trap is real and is built to look like it's your fault, even though it's designed that way on purpose. But if you know how it works, then you don't have to stay in it. You deserve better than carrying debt month after month while the system profits off of your stress. If this video has helped you open your eyes, good, because that's the goal. I'll see you at the next video.